Well, welcome everyone. My name is Justin Martels. I'm the co-head of the ESSEC-Amundi Chair on Asset and Risk Management. I'm very glad to welcome three guest speakers today for the second edition of the webinar, which will be on ESG investing. The first presentation will be by Marie Brière on personal values, responsible investing, and stock allocation. And this will be followed by a presentation by Olivier-David Zerbib on sustainable capital asset pricing model, evidence from green investing and sin stock exclusion. And finally, we'll have a presentation by Lioui on chasing the ESG factor. So each guest speaker have 30 minutes basically to present, and then we'll have about 10 minutes of questions at the end, so you can step in at the end and ask questions. So I'll leave the floor to Marie for a paper on personal values, responsible investing, and stock allocation.
Thank you very much, Jocelyn. Let me share my screen. Can you see them?
Yes. Perfect.
Okay, great. Thank you very much. Thank you very much, Jocelyn, and the organizers for inviting me to present this paper, which is joint work with Stefano Ramelli, and Stefano is here as well. So Stefano, please don't hesitate to step up at any time if you wish. And which is about responsible investing and stock asset allocation. So the starting point of this work was the growing interest of retail investors in socially responsible investment. The growth of products that are sold to the retail market has been very large over the recent years. For example, if you look at the total assets, total social responsible assets, now social responsible retail investment products account for close to 30% of the total assets, while they were only 3.4% in 2013. Sorry. So the market was mostly institutional, and it is now more and more growing into the retail space. And these are European figures, but if you look at the US, you find the same growth. Now in the US, 25% of the social responsible assets are for the retail market. If you look at pension funds, you would see a similar picture. There is growing demand for social responsible investment also among pension plans. And here you see a couple of press articles that were reflecting this growing interest from pension plan members that were asking for more social responsibility in the way their assets are managed in the pension fund. And of course, that generated a lot of debate, especially in the US. And maybe you remember the Trump administration discussions last summer where they were asking about the fiduciary responsibility of these pension funds and asking if social responsible products would be compatible with the fiduciary responsibility of pension funds. So they were questioning the performances of social responsible assets and their desirability in the pension plans. So most of the debate has focused on the performance of social responsible funds, but there was an overlooked point, which is the one we are focusing on in this paper, which is the following. Maybe the offering of responsible funds is also affecting the investor's portfolio decision, and it might also affect the portfolio asset allocation and the risk-taking behavior of pension plan members. So that's a question we are tackling in this paper, looking at how much does the new offering of social responsible products affect the portfolio choices of retail investors. And the question is particularly important and interesting in our point of view, because there is this stock market participation puzzle, right? I mean, in many countries, there is a low stock market participation, at least low according to the academic standards. And there were a lot of attempts to try explaining why people do not invest enough in the stock market. So for example, here you have some US figures, and it shows the percentage of of households that invest in the stock market. It's relatively low, close to 55% today, and it has decreased also with the subprime crisis. Now you can see this decreasing trend happening in 2008. It has been decreasing from 62% to 52% after the subprime crisis. So this low stock market participation is really a key topic in household finance. It's also a policy objective because it has potentially large welfare effects, especially in a context where more and more people are responsible for their pension decisions. So if they don't invest enough in the stock market and if they are unable to capture the equity risk premium, this might have a detrimental effect for their long-term performance and potentially the wealth that they are able to accumulate in their pension plan. And unfortunately, we have similar figure and probably even worse in Europe. Here, these are so Observatoire de l'Épargne Européenne data, which are based on Eurostat data. You can see France compared to all European countries. So the share of listed equities in households' portfolio is close to 6% in France. It's close to the European average. It's slightly higher in Nordic countries, Finland and Sweden. Here, I need to mention that these are only listed equity, not investment in equity mutual funds or unlisted equities. But still, there is this low stock market participation in most countries. So why don't people invest in the stock market? As I mentioned, there is a huge academic literature tackling this issue and try to find good reasons for that. And the drivers that have been proposed for this low stock market investment are going from financial factors, for example, informational cost. It's costly to gather information on the stock market, to behavioral factors that looks like very important to explain investors' behavior. Financial literacy, for example, is very important. More financially literate individuals invest more in the stock market. Optimism is also an important factor, which is typically related to earlier life experience. So people that experienced a good stock market performance in their lives, they tend to invest more in the stock market than people having a bad experience in the stock market. And this optimism is also related to interpersonal trust. And there is this interesting paper by Guizot and co-authors on that. But also, and more recently, some additional factors have been proposed to explain this low stock market participation that are related to what we could call social and cultural factors. For example, the paper I just mentioned by Guizot and co-authors show that there is stock market aversion by a substantial part of the population that is related to social capital, for example. It can also be so that they proxy that by the voting turnout, for example. But the stock market aversion is also related to political preferences. For example, this famous paper by Costia and Torstilla find that left-wing voters are less likely to invest in the stock market than right-wing voters. So these factors that we call social factors, social preferences, can explain why some people do not want to invest in the stock market. So that's our first hypothesis. There is what we could call stock market aversion. So left-wing or pro-social investors, they are less likely to invest in stocks because of what we could call a generalized antipathy towards capital markets. But at the same time, we know from another branch of the literature that these pro-social investors or left-wing investors are more inclined to invest according to socially responsible criteria. There is ample evidence of that. For example, by Hong and Kostovetsky, who are looking at mutual fund managers and showing that in the US, for example, Democrats, so fund managers that are giving to the Democratic parties, they tend to invest more responsibly. So they hold more stocks that have good social responsible ratings. And there is also recent evidence by Reader and Smith and Anderson and Robinson on these questions. So we have these two hypotheses. First, that there is a relationship with the pro-social preferences and the stock market participation, and at the same time, a relationship between these pro-social preferences and the social responsible investment. So that led us to our conjecture in this paper. If you aggregate these two hypotheses, that responsible funds could allow pro-social investors to invest in the stock market while avoiding the cognitive dissonance of investing against their values. So it could be, and that the hypothesis that we're going to test in this paper, that the offering of socially responsible funds might increase the stock market participation. So we're going to test that in a database of employees that are working for firms in private sector companies in France. And we have data coming from close to 1 million active participants in employee savings plans in France in 2017. And we're going to look at the impact of including a responsible equity option in the fund's menu that is offered to these plan participants. And what we will show is that the inclusion of a responsible equity option is associated with an increase in the stock market participation by plan participants. In average, people that are offered a social responsible equity option, they invest 2% more in equities relative to an average which is 12%. And in a diff analysis, when we look at the new money which is invested in the plan compared to the previous asset allocation of the plan, we show that introducing a new responsible equity fund is generating a 7% increase in the participation appetite to stocks. So let me, before I go into the empirical analysis, but tell you a few words about our empirical setting and the savings plan in France, because some of you might not be completely familiar with these employee savings plans.
Can I just ask you a question, Martin?
Yes, sure, Sophia. Yes.
So I was thinking about the reasons to invest or not. So many investors that said that they were not investing in social responsible because of greenwashing, right? So they were concerned. So can you control for greenwashing in the sense that, you know, some funds that are certified and the investors are really sure that it's a social responsible product and just not the label that...
Yeah, that's a very interesting question. Indeed, I will show you that we are analyzing a very special type of social responsible funds that are labeled by an organism which is called Financial. I will explain you that we're looking at solidarity funds. So we can expect that there is no greenwashing because it's a certified third-party agency.
When you presented the motivation, you put like there risk aversion, but maybe inside this risk aversion, there was this fear that in fact you were just investing in a product you are not sure 100%. So maybe like risk aversion, but to greenwashing, right? So
yes, no, I fully agree with that. We are not testing if greenwashing matters. We do not have two categories of funds. Some where we would suspect greenwashing and others where that would be labeled by a third-party institution. But what we show is that for funds where there is a strong credibility because they are labeled by a third-party institution, we find this impact. But I'm not able to tell you if there would be a differential impact, if there would be more suspicion of greenwashing, which is your question. And I think it's a very interesting and important point. And on that question, we're not able to answer. So this savings plan in France, for those who are not familiar with that, they look very much like the 401k in the US. So they are offered by employers to their employee. And what the employer proposes is to save either for the medium term in what is called PEE, so it's 5 years maturity, or for the long term, meaning for retirement in plans that are called PERCO. And the employer is giving every year to their employees variable remuneration that is saved into the plan. So there are tax exemption if you save in the plan, just like in the 401k. And then employees, they choose within a menu of funds that are proposed by the employer. So then they can freely choose their asset allocation within the menu of fund that has been decided by the employer for them. So it's very used, very common, because according to the DARES, 56% of French employees have access to at least one form of such saving schemes. So that I mentioned, there is variable remuneration that is saved within the plan, and people can choose within the funds menu. One very interesting feature of these employee savings plans is that, according to the French law, responsible investment is mandatory within the firms. So within the funds menu, the firms should propose at least one social responsible fund of these very special type that I mentioned to you, which are solidarity funds. So firms offering PE or PERCO, so these two types of saving vehicles, they are obliged by the law to offer at least one solidarity fund, which is this special type of socially responsible fund. And what are these solidarity funds? So these are socially responsible funds in essence, but that are required to invest between 5 and 10% of their assets in accredited solidarity-based enterprise that should have a social utility. So what are these firms that have a social utility? These are firms that could, for example, provide access to housing, or employ disabled people, or preserve natural resources, or spend on education, that kind of thing. So they are focused on special purposes that should be of special utility, and they are accredited by the third-party organism that I was mentioning before, which is called Finansol. There are very particular type of social responsible product, very popular in France, I will show you, and also they are by the law mandatory in the funds menu offered by the firm. So what we are going to define as responsible investing in this paper is investment made through these solidarity funds. So there are three main advantages to do so. So the first is that these solidarity funds, they have characteristics that are defined by law, as I just mentioned to you, and they are also labeled by a third party. We are less concerned about the endogeneity nature of the responsible fund offering, because the firms are obliged by the law, they have no choice than offering these solidarity options. And the third point is also that the solidarity funds are very well known by French employees. And here I quote a survey that has been made by Vigeo Eiris in 2019, asking retail investors about their knowledge about social responsible products. And as you can see, solidarity funds are very well known. 67% of the people that were asked know the existence of these products. It's close to the knowledge of crowdfunding, also very high, 68%. But if you look at the last line, people have a very limited knowledge about social responsible in general. So only 35% of them declare that they knew what is social responsible investment. So they're also particular in the sense that they are known by the French employees. The data we have is cross-sectional data on portfolio decisions that were made in end 2016 and end 2017. And we cover, as I mentioned before, close to 1 million employees working in around 6,500 firms, covering most of the French departments. All plans in our sample include at least one solidarity fund that can be either an equity fund, 64% of them propose an equity fund, or a balanced fund, and 78% of firms are proposing a balanced fund. And 4% of the plans introduce a new solidarity equity fund in 2017. So our identification strategy relies on that, the fact that there are firms offering responsible equity funds and firms offering only balanced funds, and that some firms introduce a new solidarity equity option in 2017. And we're going to look at how much does that have an impact in the asset allocation of employees. So these are the summary statistics. So it's mainly summarizing what I told you. Maybe at the individual level, it's more interesting here. So what we know is that at the end of 2016, people invest 12% in average in the equity market, excluding stock market participation. So it's here investment in diversified equity funds. At the end of 2017, the money invested within 2017, so the new money received, the variable remuneration is invested 13% in average in equity, and the difference is 2.72%. So our empirical strategy relies on two main equations. One, which is just a cross-sectional analysis, where we compare the share of the new contribution, so the new money, the variable remuneration that is received in 2017, across people working in firms that offer a responsible equity option, so a solidarity equity fund, if you wish, and those working in firms that do not offer such an option. And we're going to compare how much they invest in equity in both types of firms, basically. So we're going to run cross-sectional regressions where we compare the amount that is invested in 2017, the new money invested, and regress on the dummy if a solidarity equity option is offered, and a bunch of individual controls and firm controls that control for individual characteristics, but also the structure of the menu of funds that are proposed to investors, also the incentives, for example, the matching formula, etc., in the plan. And then the second type of regression is a definitive analysis, where we look at the change in stock asset allocation decisions. So here we compare how much is invested in 2017, so the new money invested in the plan, minus how much was invested in equity at the end of 2016. So we look at the change in asset allocation, if you wish, between the new money investment and the total plan asset allocation investment at the end of 2016. And we look at how much does that change when the employer introduces a new responsible equity fund in the fund menu. I told you that 4% of the firms offer a new responsible equity fund in the menu. We're going to look at the impact of this change on the changing asset allocation of individuals. Again, we control for individual and firm characteristics and also cluster the standard error at the firm level.
Marie, can I ask you a question?
Yes, please.
Can you come back one slide? So your responsible EQ, I presume that's a dummy variable to control for the fact that they offer. Now, do you have, for example, they may offer many funds, and this may have an impact on the percentage of equity that people will allocate in their portfolio. Do you control for this, or?
Yes, we control for the percentage of equity funds that are proposed in the menu.
Okay.
So I will show you in the regression, it has an impact on the asset allocation. Yes, we control for the number of funds and for the percentage of equity funds that are offered, and you can see it here. So number of funds, and the more equity funds are offered, the more people invest in equity.
But this is the number of funds, not the number of solidarity funds, because I presume a company can choose to have many solidarity funds, which will have an impact on the allocation of agents. Could have an impact.
That's a good point. Yes, that's a very good point. We could control for that. Yes, thanks for this suggestion. Okay, so let me give you the result that we find when we look at the first type of regression, and so the cross-sectional analysis. So here we compare people that are offered a solidarity fund versus people that are not offered this solidarity equity fund. And we are interesting. So we have the controls that Jocelyn was pointing at the individual level, female age and account size, and also at the firm level, at the plan level. So we control for the mean match rate, the maximum match amount that people can receive, the structure of the fund supply, the fund menu, and also the number of employees. So let me focus on the variables of interest here. So the dummy for responsible equity fund offered in the plan. And what we find is that people that are offered a responsible equity fund, they invest more in equities by 2%, and it's quite substantial because it represents approximately 1/10 of the standard deviation of the stock asset allocation in 2017. We interact this variable also with individual characteristics, and we find that the effect is stronger for male, for young participants, and for people having a larger account. And finally, in the last regression, we control also that the effect is driven by the proper investment in these solidarity funds. So we introduce a dummy for people that are responsible equity investors. So for people actually investing in these responsible equity fund. And we find that more than 2/3 of the effect that we find initially is explained by people being a responsible equity fund investor. So there is a little bit of spillover in other funds, but most of the effect is driven by investment in the solidarity equity fund option. So we have a robustness checks for firm offering PE and PERCO, so that are by law obliged to offer solidarity option. We find similar results, even slightly stronger. We find 3% instead of 2% increase in the asset allocation. And again, the effect is mostly driven 2/3 by people being responsible equity investor. In the second type of setting,
Marie?
Yes?
What is
yes, please, Didier.
What is the dièse for? The dièse sign in the previous...
It's for number. It depends.
It can
be number, but here it's interacted. So okay. Responsible equity interacted by female. So just the interaction of the two variables.
Okay, thank you.
So second type of regressions, these are the diff-in-diff regressions.
Sorry.
Yes?
Sorry, if I may, I have a question. Have you checked the change in investment in the fund or investment in the whole PE and PERCO? Or to say it in other words, does this Fonds Solidaire change the investment behavior only related to the Fonds Solidaire or to the whole PE or PERCO set of funds?
So what we look at here is the investment made in all kinds of funds that are offered within the PE and PERCO. And in the last regression, we control for the fact that this asset allocation, so this higher asset allocation to equity that we find as a result of regressions, is driven by investment on these solidarity funds. Does this answer your question?
Yeah, but for example, if these people, for external reason, decided to invest more in equity, I don't know, because of the stock market evolution, or because of any kind of change in their behavior, maybe they would invest more in equity, not only in the Fonds Solidaire, but also in other Fonds Action of their PE or PERCO.
Yes, I see what you mean. Yes, to proper control for that, we need to go in the diff-in-diff analysis, because here, I think I will answer your question here, because here we are going to compare the differential impact that we can have when you introduce a solidarity fund and when you introduce a normal equity fund, and you will see the difference. So maybe let's come back to your question, if you still have it, after I present you the definitive regression results. I think that's a good point, because in this cross-sectional analysis, we do not properly control for that. I agree. So in this definitive setting, we look at the impact of introducing a new fund, a new solidarity equity fund, in the menu of funds that are proposed by the firm. And we look at how much does that change the asset allocation of individuals. And for that, we compare how much they invest the new money received in 2017 versus how much they invested in 2016. And you have the first two columns, for example, that are showing you the impact of introducing a solidarity equity fund. That's column 2. And for column 1, it is looking at the impact of introducing a conventional equity fund in the funds menu. And what you can see from these results is that introducing a responsible equity fund, also a solidarity fund, is associated with an increase in the stock asset allocation by 7.2%, and it's very large economically. Remember, people invest in average 12% in equity, and it's accounting for 1/2 of the standard deviation in the shift in the asset allocation. And we have this placebo test where we look at the impact in column 1 of introducing a conventional equity fund in the fund menu. And here you can see that there is no impact, no significant impact, even slightly negative. So introducing a new conventional equity fund has no impact on the asset allocation. So it looks like the possibility to invest in equity responsibly makes the stock allocation more appealing to a significant fraction of the employees. So I'd like to yes?
Can I just ask you a question? If you come back to the slide, my question is the following. Suppose, so they have two choices: either invest in conventional equity, that could be a balanced fund where you have equity, debt, I guess, and different things, or solidarity funds. Is that correct?
Yes, or solidarity, that can also be either equity balanced. So there are also various types of solidarity funds.
So what I have in mind is the following. Suppose you didn't have any solidarity funds. You offer one. The solidarity funds is composed only of equity, I think. So of course, if they simply reallocate part of their wealth to this, by definition, you will have, mathematically, you will have an increase in equity holdings, because you go from, for example, from a balanced fund to a pure equity fund. So there will be an automatic mechanism where you hold more equity, basically. So my question is it a substitution effect or a real sort of wealth effect, in the sense that you've created a new demand for equity rather than have a shift from one type of fund to another one?
Yes, so I think I see your question, but when you say it's a reallocation from one type of fund to the other, it's still a change in your asset allocation. So imagine that you were only offered a diversified fund, for example, that is a balanced fund, which is investing in stocks and bonds, and now you're offered a new solidarity equity fund. The fact that you decide to change your asset allocation and then hold more equities is still something which is a decision to change your equity exposure, right? So So then you tell me it's driven by the fact that it's a new fund that is offered. It's not that people are willing to invest in equity. It's just that there is a new fund offered, and because they invest in that new fund, that completely changes the asset allocation that is dedicated to the equity as a result. But then my answer would be, but yes, but in that case, that should be also true if you offer a new equity fund. And then if you think that, for example, there are some papers showing that people tend to allocate 1/n over every option available. So then that should also shift the exposure to equity when you are offering an equity fund, right? So I think the diff analysis, which is showing that there is no such an impact when you are offered an equity, a conventional equity fund, tells you that the effect is not driven by just the introduction of a new fund that might distort your asset allocation, which is, I think, the effect you have in mind, Jocelyn.
Yeah, that's right. Yeah, you're right. You're right.
Okay, so maybe a few words about the discussion of the channels. What can explain that people react differently when they are offered a new equity fund and when they are offered a conventional one and when they are offered a new responsible equity fund? So according to the standard theory, the offering of a responsible fund option should not affect portfolio choices, right? As long as equity investment is feasible, you shouldn't have a higher allocation to the equity market if the option is responsible, right? So why do we observe these different behavior? There are two possible explanations and channels. One is the standard risk return expectation. You might think that investors perceive the sustainability features of responsible funds with a superior future risk-adjusted performance. And there is ample work on that, on is the ESG factor remunerated or not? Abraham has very interesting work on that. For example, you might think that people have views on that. They have a certain expectation on the abnormal performance of ESG funds versus non-ESG funds. So that's the first channel. Just to show you the historical performances of solidarity funds versus conventional equity fund, you see the two lines, and the green and the red dotted line, they're almost similar. Indeed, if you test for the significance in the difference between these two types of funds, it's not significantly different over the sample period, and there is a slight underperformance of solidarity fund returns. So it's difficult based on that to think that people might expect that solidarity funds should outperform a lot conventional funds in the future. So if this is not risk return expectation, but we should test properly for that, the other channel that might play a role in, and which is what we would like to test in further work, is a personal value explanation. It could be that responsible funds is attracting investors that would have been otherwise reluctant to invest in the stock market because of the stock market aversion, so cultural reasons that I was mentioning in the first place. And the fact that you offer them a responsible equity fund might help them to overcome this aversion to the stock market. And so the pro-social investors, so those having these social preferences, might be more willing to invest in the stock market if it is a solidarity fund option, a social responsible option. And as I mentioned, there is already some evidence that the responsibility increases the trustfulness of stock funds. So that is the hypothesis that we would like to test in the future by running a survey. So we've been working on a draft survey of plan participants to try to identify and disentangle these two hypotheses, the risk return expectation from the social preferences, and try to explain what is driving our results.
Marie,
so just to conclude, yes?
According to the previous chart, the ESG fund seems to be more risky, but I see the peaks and troughs. Did you hear me?
Yes, I can hear you. Yes, it depends. You're right. In 2007 and 8,
and lower.
Yes, but
okay.
I see your point. But yes, I don't remember exactly. I will check that. That's a good point, because in the academic literature, if you look at social responsible investment, it's on the contrary more in crisis time tends to do better, more resilient in crisis. We would need to check properly for that. But it's true, if you look at 2007 and 2008, you're right.
Thank you.
Maria, I suspect, I don't know, but I suspect that these solidarity firms may be lower in size than the firms in conventional equity funds.
Lower size, yes. I think yes,
firms.
you're right. Yes. No, these accredited firms are typically smaller
but
firms.
Normally they should be less diversified. So it may explain the higher volatility of the returns. Okay.
Yeah.
Yes, that's a good point. That's something we should check and investigate. Thanks for these remarks, Didier, Jocelyn.
Thank you. Marie, I have a question. Because in fact, as you mentioned, currently in the academic literature, it's said that ESG funds are having lower risk, and I'm quite surprised about your graphic. But what is also documented in the academic literature is that there was a timing factor, meaning like ESG was not very much relevant in the early up to 2010, 12, let's say 13, and suddenly it picked up. So there is a regime change, and therefore what you are seeing in your graphic is hard to use, because in fact we are observing different regimes. So and as well, I was wondering if you do a linear regression somehow. You don't account for the fact that the nature of the regime have changed. So, and there are right now a lot of machine learning methodology to somehow make the model adapt to the regime, so that you could find something that would slightly differ in a sense from different period of observation. Do you have anything in mind like that?
No, I fully agree with you on the point that an outperformance has been, for example, documented after 2005, and that the investors' behavior. With Stefano, we have another project exactly on this question, that investors' demand shifted after that point, and that was one of the explanation why there was this outperformance after that period. Here, the paper is not on the performance, but on investors' behavior, and what we look at here happens after 2005, right? So it's something which is after 2015. So in a period, if you wish, where investors were already demanding for social responsible investment. So what we want to do here is just control for people's expectations, and in any case. Here I'm just documenting the past performance, but what we would need to control for are the proper expectations of individuals in the plan, to see if do they expect outperformance of ESG funds or underperformance of these funds, and disentangle that from the other hypothesis, which would be related to different preferences, right? So I'm not sure we want to go in a detailed way in the dynamic nature of the relationship on the returns, but more to understand people's expectation on future performance and understand if it's a driver of their appetite to the stock market.
And I have
Marie, as you know, we're running out of time. There's two questions, actually, maybe two quick questions by Gregory Schneider and by Anderson. Yes. Gregory, you want to start?
Anders first.
Okay, thanks, Marie. Very interesting paper. And I also think the results line up very well with the survey evidence we have in Sweden. I just had one comment or question is about the magnitudes here. You're basically looking at the change in weights here. Did you ever try to look at the magnitudes or the allocations in monetary terms? Because I think that, you know, many of these social investors are on average younger and have lower income. So maybe that would actually, you know, help you in building your case if you find some weaker evidence if you reweight it.
Yes, that's a very good point. We didn't do that, but we should do it. That's a very good point. And also check heterogeneous effects, maybe depending on wealth, that kind of thing. That would give very good insights on what are the potential implications, or very important policy implications of these results, that you can really benefit these people if you offer them social responsible funds. So that's an excellent point. Thank you very much, Anders.
Gregory?
Yeah, my question is about this, the use of these solidarity funds, because in the Amundi PE and PERCO, well, you have solidarity funds and else you have SRI funds.
Mm-hmm.
So, and even some labeled SRI funds.
Yes.
So my question would be to know whether you checked first with the labeled SRI funds, and well, so it would be difficult, maybe not for Amundi, but for the whole industry. I mean, scientifically, it's fairly interesting to see why, and to check that solidarity funds are kind of impact funds,
mm-hmm.
the French way to
yes.
say it. And second point is about this. Second question is about the performance difference between solidarity funds and others. Well, it's given that you have solidarity SRI and neither solidarity nor SRI, it would be maybe relevant to have more detailed presentation of the performance difference,
mm-hmm.
and maybe also by asset class, or if you focused only, make it simple, focus only on equity, and there we would see whether there is a difference in between solidarity and SRI equity funds.
Yes, so we checked that in the first place, and the effect is much weaker if you look at SRI funds in general, but we didn't check for labeled SRI funds, so that's another distinction you make, which is interesting. So we could certainly refine the analysis. And also for SRI funds, the problem is the endogeneity nature of the offering. You might claim that more responsible funds in general, they also offer more social responsible investment to their employees in the first place. So that's why we focused on the solidarity option. But thanks for making this point.
Because maybe one short point on solidarity funds, there are funds invested in 90%. For 90% in normal stocks or bonds, mm-hmm. and 5 to 10% into non-listed, how could I say, yeah, kind of benefit corporations in the French way,
mm-hmm.
And mostly they're investments are made in bonds or loans.
Mm-hmm.
So that's also why it's a kind of cushion, performance cushion.
Mm-hmm. Okay, thanks a lot for these remarks.
Okay, I guess we went out over time.
Okay.
Sorry, thank you, Naif. Very interesting presentation. Obviously, a lot of questions. So we'll have to stop it there. Thanks for all your questions. So if there's no other question, we'll move on to the third presentation by Abraham Lioui on chasing the ESG factor.
Okay. Do you see my slides?
Yes.
Perfect. So 30 minutes, right, Justin?
That's right. Well, 40 minutes in total, yes.
Okay, thank you very much. Okay, so thank you all. It's quite a bit, tough to speak after Marie and Olivier, but I try to skip many things that they have said and really motivated. So this is a joint paper with Andrea Tarelli. It is about chasing the ESG factor, okay? I will start by motivating the paper, provide you with the theory behind the paper, some data description, findings, and finally the conclusion. So what's the motivation for this paper? I think no need to repeat what others have been saying. A huge buzz around ESG and ESG investing. So here you see the popularity of the words ESG and ESG investing in the Google Trends. although it's interesting to see that the upward trend is relatively recent, last 5 years, okay? And if you look at Factiva, which is a database of a lot of newspapers, academic journals, etc., you observe exactly the same trend, huge buzz around ESG and ESG investing, sustainable finance, green finance, climate finance, etc. And obviously, this is not only a narrative interesting to ESG, it has material impact as the flow of funds to the so-called responsible investing is trending also. We are here in 2020, we are already at 60 trillion. And you see by yourself the upward slope of this trend of the amount of money flowing into the labeled responsible funds, etc. And we do see asset managers, this is something from yesterday, where BlackRock now is linking its borrowing cost to diversity and sustainable investing targets. So it's really becoming something which is material. Now, obviously, we have a huge buzz around ESG investing. Asset manager, of course, care about this buzz and maybe try to read it. So that's the point that has been raised by Sophia. Greenwashing is unavoidable. Okay. So, for example, in January 2020, BlackRock said, "Well, no, we want our firm where we invest to care about our environment, etc." And some NGOs saw that during 2020, BlackRock was not supportive of the resolution in the General Assembly of Shareholders related to climate risk, while Amundi was. 78% of the cases where Amundi was in the room, they supported this kind of class. Okay, and this just before we came here, you just see that there is also some political pressure surrounding the taxonomy and the disclosure that is that the European Union is trying to put in place. And finally, there was a risk alert 2 days ago or 3 days ago about the SEC saying that all these funds pretending to be socially responsible, maybe they do not deliver whatever they deliver. So to wrap up, fact one, huge buzz around ESG is investing. I include environmental, green, climate, whatever you want, okay? Second, fact two, a huge flow of funds to the market. So clearly, as asset pricers, as academics, we do expect an impact of these trends on the market. Which impact could we expect? So in fact, first impact, if people care about the ESG rating of stocks, so they are valuing the non-pecuniary benefit of holding high ESG stock. As such, we should expect high ESG stock to experience a negative alpha. Okay? However, if the preferences and the tastes for ESG change through time, as Olivier explained it very, very well, this can blur this relationship between ESG and returns. And finally, we talked a lot about certainties, the greenness of the firm, the brownness of the firm. In fact, there is nothing which is more uncertain than the greenness and the brownness. And this is something that's been raised here and there about the disagreement between data vendors. And there is a beautiful paper which I urge you to read, which shows the material impact of the disagreement between data vendors and the ESG profile and the uncertainties around the ESG profiles of the firm. When we arrive at this fact tree, a lot of buzz, uncertainty about the market impact. In fact, it's hopeless to discover an ESG factor because ESG factor in general, you are looking for an alpha. But here it tells you that there is no alpha. So yeah, the alpha can be positive or can be negative. Okay? So hopefully it's not what our paper is about. Our paper is about identifying another source of confusion about ESG. And to materialize this idea, let me show you a recent paper which has just been accepted at GFE. In a recent paper, these two authors, they showed that stocks of firms with high CO emissions earn high returns. Okay? So there is a penalty to being high emitter, or in other words, if you are environmental friendly, the market rewards you through a negative alpha. So far, so good. Problem, not less senior team came with this paper and found that strategies that lowered carbon emissions more aggressively performed better. So we have two papers. One says high emission, high return. The other says low emission, high return. So completely opposite findings. Now, you can try to figure out many reasons why it is the case, but the point is the following one, and this is what triggered our interest into this paper. In fact, they're using the less disputable data about emissions, which is scope 1 and scope 2. Okay, so the data vendors, as Olivier has put fairly on the table, data vendors may disagree, and it's not obvious that their measure of environment is the best measure to use. But here, there is no disagreement on the data. They're using exactly the same data and reach opposite conclusion. And this is where our paper jumped in. In fact, when you look at an ESG factor, indeed, our paper is much broader. It's about the factor analysis, broadly speaking, size, value, profitability, momentum. We here focus on ESG factor, but it has far-reaching consequences about the common practice to build factors. When you look at the factors, in fact, you have two possibilities to build a factor. One is in the time series, Pharma French. You sort stocks into high ESG versus low ESG, okay? You long the high, you short the low, and you see how is the factor performing, what type of alpha the factor is delivering, okay? The second approach, which is the approach used by Bolton and Kaspersky, it is the cross-sectional approach. And in fact, to make the difference between the two concrete, think about two stocks which have the same market size. One has an ESG rating 0.4 and the other one has 0.2. If they belong to the high ESG bucket, in the time series approach, they will have the same weight in the factor. Why? Because they have the same size. But according to the cross-sectional approach, the stock with a rating 0.4 will have a weight which is double the stock which has a rating which is 0.2. So the time series uses the ESG metric as an ordinal metric, while the cross-section approach uses the ESG metric as a cardinal metric. And obviously you ask yourself, okay, so what's the best approach to build a factor? What I'm saying for ESG is true for size, value, operating, all the 400, 500,000 of factors existing in the literature. And there is a recent paper by Pharma French which concluded that the cross-sectional approach is better than the time series. And what we are doing in this paper is to suggesting a unified approach for factor construction. And just to tell you where the conclusion of Pharma French is problematic, here is the point. Suppose it is true that there is a relation between ESG and the returns. Okay? So if it is true, when you do the time series approach and the cross-sectional approach, you don't know what is the ESG rating of the two factors. Okay? Which means that if they don't have the same ESG rating, you cannot compare them. By construction, they will not have the same return. So the comparison that is done in the literature, and in particular done by Pharma French with the standard factors, is problematic because the two factors, the time series and the cross-section, they don't have the same exposure to the characteristics that you care about. As such, you cannot compare the factors. So our paper is about providing a unified approach, unified method for factor construction. What is our methodological contribution? Our first methodological contribution is to provide a method that helps you control for the rating of the ESG factor. So you use the cross-sectional approach and you decide what rating do you want for this cross-sectional factor. Why is it interesting and useful? Because you can control the rating of the cross-sectional factor to be that of the time series factors. And when you do so, in fact, the spread between the two, its expectation is 0. So when you do properly time series and cross-section, you should not expect any discrepancy between the factors delivered by the two methods. Now, the spread is 0, but the variance is not 0. Hence, the spread between the two is noise. And the nice thing is that we can identify the noise to be directly related to the norms of the portfolio. It means that the two factors have different level of regularization for the machine learning guys, okay? And this different level of regularization is exactly what drives the noise that between the two things. The factor is easy to extend to control for the characteristics, okay? Which you cannot do with the time series factor. When you do portfolio sorting, you can do double sorting, you can do triple sorting, but that's it. If you want to control for 20 characteristics, it's impossible to do it with the time series factors. Why? It is straightforward with the cross-sectional factor. So first main methodological contribution is to show that when you adjust properly the cross-sectional approach, there is no more any difference between the time series and the cross-sectional approach. When you do not control for characteristics, when you control for characteristics, you will find differences. Why? Because the cross-sectional approach has zero exposure to other factors, size and value, while the time series approach still have exposures. This method is super for what? To provide an elegant method to build ESG factor. Now, you can build an ESG factor where you decide about the rating and you can tell how well you will do if you were to choose the top 25% stocks instead of the 10 top 90% stocks in terms of ESG rating. You don't need to screen stocks. You will keep all the stocks in the portfolio, no need to screen, okay? Which means that you don't change the diversification that you have access to through the stocks universe. You have zero exposure to other characteristics, so you are identifying pure ESG factors. And finally, you naturally account for time-varying tests and time-varying risk aversion. Why? Because by construction, these factors are built at each time t without using forward or backward information. So the premium of the factors are built at each time t. What do we do empirically? So empirically, we first, in the data we have and in the sample we have, we show that time series and cross-sectional factor are really close to each other when you control for the rating of the cross-sectional factor. When you control for the characteristics, that is, you shut down in the cross-sectional factor the impact of other factors like size and value. In fact, the cross-sectional factors dominate the time series factors. And the time variation in alpha is just pervasive. It's very important to account for this famous changing risk aversion, tasks, and flows to ESG. In our data set, we can identify 1% yearly alpha over a period of 30 years for stocks which rate high in terms of environment. So the environment has a valuable economic predictive ability about stock returns. And for the ESG, social, and governance, we do find much more time variation into their alpha, which means that the interplay between task changes and changing risk aversion is really important there. And finally, when we compare among data vendors, we show that the disagreement we find among data vendors, in fact, transpire into the factors if you were to build the factor for different data vendors. So what do we have? So our objective is to remove the discrepancy that can be brought by the difference in methodology used to build ESG factors. That is, we are going to provide an adjusted methodology such that whether you use the time series or the cross-section, you know exactly what you are doing, and we urge you to use the cross-section. Why? Because in particular, it allows you to control easily for characteristic, and it's crucial to control for characteristic. And then we build factors, socially responsible factors with targeted socially responsible rating. Okay? So for the theory, the starting point is the Fama-McBeth methodology, pretty trivial. It starts with the cross-sectional regression, where you take the excess return of the stocks at a given month. So you sit at a given month and you regress the cross-sectional returns on the ESG rating of the stocks. You deeming the ESG rating, okay? So as the mean of the ESG rating is equal to 0. And this regression, in fact, is a way, this is what makes the cross-sectional approach cardinal, because you are taking seriously the predictive ability of ESG relative to the returns. When you run this regression, you use the OLS estimates, and the OLS estimates show you that, in fact, what you obtain two portfolios, one portfolio per parameter, you have two parameters, the constant and the slope, and the estimators of each parameter have the interpretation as a portfolio, which is exactly here. Okay? And when you compute explicitly these portfolios, the second portfolio is the one which is related to ESG and gives you the cross-sectional ESG factor. This is this portfolio. Roughly speaking, what's the cross-sectional factor? The cross-sectional factor portfolio is just the vector ESG ratings. This is how you conclude that if a stock has 2 times the rating of another one, this stock will have a double weight in the factor relative to the other stock. Okay? So when you do time series, you use ESG just as sorting, and then you use the size to evaluate. When you do cross-sectional, you take the ESG at a rate as the weight of the stock in the portfolio.
Abraham, can I ask you just a quick question?
Please, ma'am.
You could add size, value, other factors in your regression, right? You could control for all in the cross-sectional regressions. You could control also for the size factor, for example, and that would reweight in a way to take into account this factor as well.
You are perfectly right, Marie. Give me 2 slides.
Okay.
Thank you, Marie. Okay.
I have a question.
You are right. Alors, so this is the factor that you obtain when you use only ESG as the predictive variable, but it's a nice example that pedagogically showed the point. And this factor, which has been used by Pharma 2020, by Bolton and Kasperczyk, etc., it has interesting properties. In particular, it has an ESG rating of 1. So in fact, when you build this factor, it has an ESG rating of 1. Okay, 1. 2, it is not scale invariant because, as you can see, if you multiply all the ESG by A, you divide the weight by A, and hence you divide the return of the portfolio by A. So to cope with this scale variance of the portfolio, people usually do a standardization, which is to make the variance equal to unity. But this standardization has far-reaching consequences because, in fact, it is an arbitrary and drastic regularization that you put on the portfolio. And as such, you are choosing a portfolio which is maybe far from a portfolio which makes better sense in terms of ESG. And finally, and the key driver, the key motivation for our paper, the one is how does the rating of 1 compare with the time series factor? When you sort Alpha Pharma French, you don't know what's the size of the time series portfolio. When you do the value factor, you don't know what's the value of the factor, and so on and so forth. You don't care. You use the value as a sorting. But here, you don't know what's the rate, what's the rating of the time series factor. That of the cross-sectional factor is 1. You are not comparing correctly 2 things. Our point is to adjust this methodology. And the way we suggest to adjust it is by scaling the portfolio by rho t minus 1. Okay? This may look arbitrary. I'll give you the pure economic content of this rescaling. First of all, when you do the scaling, you have 2 fantastic outcomes. 1, rho is the scaling of the ESG factor. Fantastic. Second, you don't care anymore about the scaling of ESG. You become scale invariant. No need to have unit variance. So this very simple scaling clean up many problems of the cross-sectional factor. Now, what's the economics behind it? Very simple. There is an economic foundation. It's just tilting the predictive regression. Instead of predicting using the ESG ratings, you just rescale the ratings, the predictive regression by your targeted. So now you're not thinking in terms of ratings. You're thinking in terms of rating relative to your target. It kills out the scaling problem. Okay? So this is what we suggest, and this helps solve many problems of the cross-sectional approach. In particular, when you compute the return of the time series factor and the cross-sectional factor, which are given here, this is the return of the cross-sectional factor, and this is the return of the evaluated time series factor. W is a weighting matrix. It has no particular role. It's just a weighting matrix. The formal definition is in the paper. you can show that the expected spread between the two portfolios is this one, which means that it's equal to 1 minus the rating of the time series factor divided by the rating of the cross-sectional factor, which means that if you set the rating of the cross-sectional factor equal to that of the time series factor, the expected spread is just 0. First step of comparison. Second step, the variance of the spread is this one. And this variance has a simple interpretation. Why? Because in fact, when you look at the L2 norm of the portfolios, it's just the spread that occurs in the variance. And then you can tell me, but how do you know that the spread is positive? Because the cross-sectional factor has a nice property that it is a minimum norm factor. This is why it has a lower norm than the time series factor. Okay? So bingo, we have adjusted the cross-sectional factor, and now if you compare the time series and the cross-sectional factors, you will see that the expected spread between the two is just 0. Okay? Cool. Now, how can you use it to build socially responsible factors? But you just set up the target that you want, rho, okay? And this gives you immediately the factor that you're after. You don't need to screen to be able to reach any ESG level. And most importantly, the Sharpe ratios between the two factors with different rating is exactly the same, which reflects that when you are targeting ESG, you are not impacting your diversification because you keep the same portfolio here that you are just rescaling. Okay? And finally, the embedded regularization between the two portfolios with different rating will be different, and that will be one driver of the return spreads between the two portfolios. Now, so far so good. What if we take seriously the important remark made by Marie? That is, let's augment the predictive regression with a characteristic. But here I show you the derivations for one characteristic. All what I'm going to say is fair, is true for many more characteristics. In fact, many of the features of the CS factor do hold. The new portfolio obviously will change because it will be impacted by the characteristic, but the rho keeps the characteristic, keep the feature that it is the rating of the CSR factor. The characteristic of the CSR factor is 0. That means the size of the factor is 0. The value of the factor is 0, while the size and the value and the momentum and the profitability, etc., of the time series factor is whatever. You don't know. Here, you kill all the other factors. So it's really a pure ESG factor. Okay? It's a pure ESG factor. And finally, doing the control for characteristic with CS rather than TS is much more easy to do and straightforward. When you compare now the cross-sectional factor and the value at the time series factor, the spread will not be 0. It will be just driven by the characteristics. So the time series factor implicitly exposes you to the usual factors, okay, which the cross-sectional does not. So you are impacted by the factors premium, okay. And now, if I have to sum up our new methodology, so we provided a new methodology to build up a socially responsible factor with a targeted social responsibility. You don't need to screen portfolios to target, to reach this target. And by not needing to screen, it means that it's very likely you won't affect the diversification that the market offers you. The other characteristics of the portfolio are 0, hence, you should not worry that when you invest in the ESG factor, in fact, implicitly you are doing some factor investing. Your factor investing is 0, which is beautiful. That is, you don't enter into the factors or the timing factors or the protocol to identify all these, tons of papers and that trying to identify and provide new methodology to identify factors. We're completely hedged. We don't care because our portfolio has 0 exposure to these other characteristics. Which obviously, if we were to use Fermat-French factors, we will find that they are exposed. But it's just because Fermat-French factors do not capture the true impact of the characteristic on the returns. Okay? The predictive ability drives the factor construction, so we are putting a nice and sound economic constraint on our factors. And since our portfolio is built month by month, any change in the test is built in our factor return. Same thing, if risk premia or equivalently risk aversion change through time, by construction, we are identifying the risk premium at each month. So if there is any time variation built in, it is captured. Okay, so I want to show you some empirical evidence. Okay, so recall our empirical evidence. The beauty of it is to tell you how the alpha of a pure ESG factor behaves through the time period that we have in our sample. So the baseline case is to show you the findings for 29 years, where we have used a consensus rating among 3 data vendors, MSCI KLD, which stops in 2015, MSCI AVA, which became the rating methodology of MSCI, which goes from 2007 to 2019, but the returns go to 2020, and Asset 4, which was the Refinitiv Bloomberg and Thomson Reuters, and is now LSE, okay, London Stock Exchange. And we use usual data on returns and firms' accounting data. What are the findings? So this table shows you the characteristics of the returns of the time series and the cross-sectional factors over the 29 period. We consider 2 cross-sectional factors, one with unit variance and one where we controlled the rating of the factor in the cross-section to be that of the time series, CSTS. Okay? So here you see that the 2 methods lead to completely different outcomes. Between the time series and the univariate time series, as you can see, the means are not statistically significant, but still, one is negative, one is positive. And the reason is the embedded regularization into the cross-sectional factor, together with the characteristics which play a role here, because we haven't control for characteristics. When you control for characteristics, you see that you are able to isolate an ESG factor, 0.11% of mean return on a monthly basis. Okay, statistically significant. As you can see, the time series, the cross-sectional factor is less volatile. Again, direct consequence of the regularization that you see also in the range of the returns. CAPM alpha of the cross-sectional factor, positive and significant, differently from the time series factor. And the cross-sectional factors with the time series rating equal to that of the time series factor is 0.11 on a monthly basis, okay, and statistically significant. We are not claiming that the cross-sectional factor will always win. No, in our data, as a matter of fact, for the environmental dimension, okay, because here I forgot to tell you that I'm just focusing on environmental, we have on ESG, S and G also, but just to show some empirical evidence, for the environment, the cross-sectional factor with time series rating dominate the time series factor without time series. According to the time series factor, there is no ESG factor. According to the cross-sectional factor, where you control for characteristic, there is an ESG factor. So you see, the methodology is crucial to identify a factor, and the characteristics of the cross-sectional factor still hold, even if you use other metrics like the Sharpe ratio or the certainty equivalent for a CRA investor with risk aversion equal to 5. Okay? Now, the role of a characteristic is crucial, and here you see the characteristics of the time series factor. When you look at the size, you see that it is a factor in the ESG universe, which is tilted toward big factors, it's tilted toward value stocks, and it's tilted toward profitable stocks. So when you don't control, implicitly you are doing some factor investing. And if the factors are active at some point in time in your sample, you are in fact harvesting all these premia together, which obviously will add to the uncertainty surrounding the ESG premium. When you do the cross-sectional factor controlling for characteristic, in fact, you are shutting down all these factors, size, value, profitability, momentum, investment, whatever, and it allows you to focus exclusively on the ESG characteristics of the stocks. Now, if alpha are time varying, you cannot be happy with this evidence, because this evidence by construction look at one alpha, but alpha is time varying. So what we did, we also extract, using a Kalman filter, a dynamic alpha from the returns of the factors. And as you can see, for the E factor, the alpha is time varying, but the cross-sectional factor with a time series rating has an alpha which is time varying, always positive, okay? And it ranges between 0.1 and 0.15, that is between 10 and 15 basis points. An investor investing in ESG using the cross-sectional factor with a time series control would make 40% accumulated alpha over 30 periods. So socially responsible investing in environmentally friendly stocks would have been highly rewarded by the market during the last 30 years. This is the same alpha but extracted for the cross-sectional factor relative to the time series factor. So as you see, the time series methodology generates an alpha relative to the cross-sectional methodology. Okay, so just to show you that there is a methodology premium embedded when you don't control properly for the characteristics and the ratings of the factors. Now, what about socially responsible factors? So we did the same exercise, but now we build socially responsible factor which correspond to, at each month, they target the 25th percentile of ESG rating, the 75th percentile, and the 90th percentile. And as you can see, when you control for characteristics, which allow you to identify the ESG factor, which won't be here if you were to ignore the characteristics, highly rated stocks for environment, okay, that is the 90% top stocks, okay, if you were to target this rating, you will get an average return of 0.08, statistically significant, okay? As I told you, high ESG rating is high norm. As you can see, the 90% factor has high range, high volatility relative to the 25 or 75 stocks. It's just because of the regularization. CAPM alpha, significant if you control for characteristic. Same thing for the alpha relative to the time series factors and other metrics to measure the performance of the ESG factor.
Can I just ask you something? So you said you use the ESG ratings, so the different ones, or this is
yes, you take the cross-sectional distribution of the ratings. And
yes, but at the beginning of the slide, there were several data from the ESG rating providers. So which one is these results? Just to
is for a consensus rating. We took the three raters.
Yeah, but for instance,
we have,
but there's some.
We have one second. Each time we have several raters, we average. And if you wait 2 slides, I'll show you 2 different raters.
Okay, yes, because the MSCI rating, it's a risk rating perspective, while the Refinitiv is more on performance, you know, so that's different approach. So that's why I was asking. So if you average, it's not the same perspective of the ESG rating.
It's exactly like KLD and IVA. This is why they went for IVA and not KLD. Fully agree with you. The point is that it doesn't matter about the metric because the stocks are percentile ranked for each data vendor. So whatever methodology you use, you give me a ranking. Okay? So there is heterogeneity, of course. I am just using the ranking. But fair point, I'll show you 2 different data vendors. We are not trying to hide that different data vendors will use different factors. Okay?
Can I ask another quick question? When you control for other characteristics, are you using individual stock characteristics or are you regressing the stock return on Fama French factors, for example?
Never ever, Marie, never ever. Because if we use Fama French, Luzon will say it's completely crap, don't use it. Okay, so no. We are using individual characteristics.
Okay.
We are never using other factors than the alpha. By the way, this is why the CAPM alpha is the only thing you should look at. Why? Because in the multivariate case, we already control for characteristics. We are not going to put the Fama French factors, we control already. And in a proper way, not with just factors that we don't know necessarily what they are capturing. So it's really a clean way to control for characteristics.
Okay, great, thank you.
My pleasure. Okay, so here, for example, for the environment, as you can see, you can build a factor which target high ESG rating. And in our data, we are not saying it's a rule, as I told you, too much disagreement about what should it be impact. But in our data set, we show that the CS factor does dominate. Okay? When you look at the time varying alpha, same thing. You have time variation in the alpha depending on the rating that you are targeting. Okay? The finding I'm showing you is super robust. I'm going to talk about it very quickly. Here, on the right-hand side, you control for characteristic. On the left-hand side, you don't control. As you can see, for the top-rated portfolio, you still have positive alpha, time varying, but at lower level than the right-hand side. If you control for small stock, which is something that people are really afraid of in the literature, as you can see, usually small stocks are the driver of the findings. As you can see, the picture doesn't change when you add small stocks. It pushed down the alpha. It's just because in our sample, small stocks particularly underperformed in our small sample of 30 years. Okay? And now, here is what you were looking for. What about different data vendors? As you can see here, when you take MSCI IVA and you take asset 4, the picture that you have is the same in the 20s, but it's no longer the same at the end of the sample. At the end of the sample, the asset 4 tend to pretend that there is a twist, okay? That is less responsible, outperform more responsible, while according to MSCI, more responsible outperform. Now, you should take carefully these findings. Why? For the simple reason that MSCI starts in 2008, which is the worst year to start. So they just capture the whole recovery of the crisis. Why? Asset 4 starts in 2002. They capture part of the recovery from the tech bubble, but they are hit by the great financial crisis of 2008. Okay, but for full transparency, this is what you have. The nice thing here is that you can really start interpreting the findings. Why? Because these are pure ESG factors from the data. To conclude, so 2 things as the takeaway. The method matters, okay? You need to do it properly when you want to measure the ESG factors. In particular, you should control for the rating and you should also control for the characteristics. So the method matters, and you should not be surprised that the 2 papers I cited in the beginning reach different conclusions. One is using the time series, the other is using the cross-sectional factors. They don't have the same rating, even though they use the same data. Secondly, the factors the method that we are offering here is a method which helps you build a pure ESG factor. That is a factor which is completely immune, no exposure to other factors. So the ESG premium that you document, which is time varying, is a pure ESG premium. Voila. Thank you very much.
Thank you very much, Abraham. Very dynamic presentation. If anyone was expected to sleep after lunch, I'm sure you kept them awake. Thanks. Any question from the audience?
I just have a more, let's say, so when you are constructing this factor, you are assuming already that is a factor, right? But there is a debate whether it is or not a factor.
No. So what I'm trying to measure is whether highly rated stocks outperform lowly rated stocks. That's the whole point of the asset pricing literature, right? That's what I call it factor following the literature, but you can call it whatever you want. What I'm saying is that I have highly rated, lowly rated, they call it factor. I want to identify the premium, the spread between the 2 groups of stocks.
Okay.
By the way, doing so, and if you were doing the time series approach, no alpha, no factor, but the cross-section approach tells you, yes, there is a factor. So you see, the method does matter when it comes to measure the factor.
But when you do the cross-sectional, it's more to see if it is priced, right? So
yeah, you want
really to see the outperformance of ESG ratings, right?
Yes, in economic words, you want to see if ESG predict returns. Because if highly rated outperform, you should find a positive slope when you regress the return on the rating. That's exactly what you are doing.
Yes.
That's what you are doing in the time series also. When you sort high, low, and take the spread, you check if the high dominate the low. But there, you don't care by how much the high dominate the low, okay? If this one is 0.6 rating and this one 0.1, or 0.3 and 0.29, you don't care. In the CS approach, whether it is 0.5 rating versus 0.2 or 0.3 versus 0.29, it matters big deal because you are treating ESG as a cardinal variable.
Okay, any other question? Great. Well, first, let me thank Marie, David, and Abraham for their three very interesting presentations on ESG. I think it was very enlightening on the state of research in the area. I'd like to thank also all the participants. It's very nice of you to attend. We're working on our next webinar. You'll receive information very soon on the next topic that will be covered in the webinar. So thank you very much, everyone. If you have any question, obviously, all the information and the recording of the presentation will be and the papers will be on our website. You can consult the website of the ESSEC-Amundi chair. So thank you, everyone, and hope to see you next time. Thanks.
Thank you. Bye-bye.
Thanks a lot.
Thank you. Bye-bye.
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 Take care.
Bye.